So here's the problem. Like most traders, they trade and they exaggerate their wins and they diminish their losses to a point where their performance, while in their head is positive, is not. And and they might think that it's profitable, but it's break even. It's just below break even, or they think that they have done much worse than they have actually done. The good part is though that when you just take the data and look at it, which is data that you literally earned yourself by risking, by exposing your money in the market, you do one thing. Well, you do multiple things. One of them is that you're risking it for the hope or for the plan for profit, right? But the other thing is that you're literally, by risk exposed in the market, so time exposed in the market, you are buying data. That's what you're doing. You're buying data. And most people don't look at it, or they don't want to look at it, or because they know it might not be that good. But that doesn't matter. The profitability doesn't matter at all. It's about the data that you buy, looking at it and understanding what the performance is. So let me start here and let me give you some examples. I have retail 1, which is, this is, when you look at the performance, this is the default of a retail trader. We'll actually have two defaults. We'll actually have three defaults, sorry. This is one default, which is a volatile retail trader, and then this is going to be a consistent retail trader, and it's very similar to that. And then there's going to be one that is somehow consistent, which doesn't have that much data, but it's still good. So let me just load those up real quick. There's a retail 2, and then I'm going to load up Bybit. So the way this works is it extracts the data and processes it. It takes a little bit, and then on top of that, we're throwing AI analysis on it. So it's going to take a little bit, but in a second it's going to be done, and we'll go over it. Here we go. All right, so this is retail trader number 1. This is retail trader number 1. The way this trader was trading was that first day they doubled their account. The next day they did like an extra 10-20%. The third day they blew it, I'm pretty sure. Then they reloaded the account. Then they traded, had a huge run. I think they went from like $20 to like $300 or $200. And then they blew the account again. And then they reloaded it, and then they blew it within an hour. That's what it was. But when we look at the actual trades, you'll see it. So this is the equity curve of the account. All right. So good win, had a loss, started trading again, had a really, really nice run, blew that account again, and then here had a very small run up, and then blew the account again. All right, so, and this, when you look at this, you might be like, okay, well, that doesn't look like me though. Okay, well, but when we look at the trades, it looks like a normal trading, there's nothing crazy about that. But and when we look at these trades, this looks like a normal trading performance to us, right? There's some red patches, there's some green patches, like that's all good. However, only when we look at the actual trading performance, we'll see the differences. And now, right now, you'll see what's important to look at and what isn't important to look at in order to understand how an account can be consistent and how an account can be trading well. So first thing, we have our key performance metrics, right? We have the overall profit and loss. I mean, that's kind of self-explanatory. We just want to see how much the account generated, right? In this case, it lost $100. The win rate is 45%. The risk to reward ratio, win-loss ratio, is 0.8. The break-even percentage is 54%, and the risk management level is 3%. The QC risk management level, that's a statistic that I made to look at something, and I will explain it very soon. So first of all, what are the key metrics? And then we have some more metrics, right? But first of all, what are the key metrics we're looking at? The main things that we're looking at, which we know, which we say all the time, is win rate and risk to reward ratio. because those two determine everything else, and I'll show you right now how they determine everything else. So when we have a win rate, right, of 45%, that means that we lose more than we win, right? There's a 55% lose rate and a 45% win rate, which is fine as long as our wins make more money than our losses. And that's our risk to reward ratio. And if a risk to reward ratio is below 1, then your losses are larger than your wins. And we see that in the analysis metrics. On average, our profit is 2%, $2.4, right, on this account. On average, our loss is $3.4. So as we trade, the way we're trading here, and this is over an okay number of trades, so you can take some statistical significance from here. So when we take this and we project it outwards to the next 1 month, to the next 10 months, this account is going to be negative. And, you know, they had some amazing days, right? If you would just look at this period in time, which was just win after win after win, well, that's great, right? But when you go a little bit further down, you have huge losses. So on average, the losses that this person makes are much bigger than the wins that they make. And that's a problem, because that puts our risk to reward ratio down. And on top of that, we lose more often than we win. So the calculation just doesn't add up at all. And and that's the issue. So what this person needs to do is trade management and risk management. Because if it's this performance, the only thing that it means is that this person does not pick the right trades. The person does not wait for the right deals, not for the good deals, right? They go into deals where their risk to reward might not be good because they don't look at it before, and their win rate, so the probability, there's not enough confirmation. Even though they might feel like they want to jump in a trade, they do it just based on feeling, but there's not enough logical confirmations for that to happen, and that's why your account looks like this. And of course, this is absolute mismanagement of leverage as well and risk. And this is what this is. We'll go over the interpretations as well, and these are a little further. This is something that we'll look at a little further. This is something that we'll look at on those accounts that are a bit better here. So this is where the QC risk management level goes into place. So what this number is the maximum percentage that you're allowed to use to lose per trade. And the way it's calculated is by looking at the win rate, right? So the win rate here is 45%. So then there's a calculation made to find the number of consecutive losses, right? So how many losses in a row can you have? And what's a 1% chance that you'll get that many losses? So what's the amount of consecutive losses where the probability of hitting that is 1%? So an unlikely scenario, still possible, but unlikely scenario. How many times do you need to lose back to back to back? And the answer is 1%. So in this case, it's 4 losses. We rounded up to 5. So 5 losses. You hit the stop loss 5. If you hit the stop loss 5 times in a row, you still cannot lose more than 30% of your account. And that's how you get to this number. In this case, it's even lower. But here, for example, it's a 68% win rate. So in this case, it's 5 losses in a row. It's a 1% chance that you'll hit 5% losses in 5 losses in a row. So in order to not lose more than 30% in that bad scenario, you only can risk 6% per trade. In this account, it's 3% because it's a much higher chance that you'll hit that many losses in a row. So that's how this is calculated. Basically, it's calculated that if a bad case scenario happens, you will still survive with the account where there's no problem of recovering. That's what this level determines. So whatever happens, you cannot lose more than 3% on your stop loss. Your stop loss cannot be lower than 3% based on the account performance that it had before. If you would do that, then you would be more profitable because you wouldn't blow your account, obviously. In this scenario, this is trader number one, and this is a much more consistent trader. And here we will see the contrast. So this trader made 30 bucks. That's great. I think it's, less trades, yeah. But they made 30 bucks. So that's nice. The win rate is 68% as compared to 45%. So what that means is that there's much more space for this trader to trade profitably, and also more space and leniency in their risk management and so on and so forth. And on top of that, to the 68%, the risk to reward ratio is 1.1. So on average, they make $2.7, and on average, they lose $1.1. So they will make much more on average that they lose. The break-even percentage is the win rate that you need to have in order to break even with your trading style. That's 47%, and currently we're at 68%, so it's fairly profitable. And the risk management level is 6%, meaning that we can risk 6% on every single trade and still be okay if we hit our 1% chance of back-to-back losses. In that scenario, we still only lose 30% of the account, which is still aggressive, and that's something that we can, move around, but that's it. Maximum drawdown is pretty high, but the profit factor looks really good. The turnover rate is 5%, meaning that we're not trading that much. The turnover rate means how often we go in and out of the market, which is pretty low. Whereas this account had 24%. Right? So look at these statistics. A profit factor of 2.4 and a turnover rate of 5%, whereas this guy has a profit factor of 0.7 and a turnover rate of 24%. That means 24% of the time they go in or out. So that's even with fees, it kills you. Number one, and then number two, the profit factor is 0.7. So you lose more on losses than you make on trades. So in order to do that, you need to have a really high win rate, but you don't. So that's why it's going to look like this. Then the next metrics, we have the Sharpe ratio, which is the risk to return. Really, the higher the Sharpe ratio is good. When you look at, we can compare this to our dashboards. Actually, that's a really good thing to look at. Let me go to strategies. Let me turn on, say, the turtle here. Let it load real quick. So the Sharpe ratio is 0.3. If it's positive, it means that you're making more profit for risk that you put in. And then the volatility is a bit high. Everything about like a 3-4 is high. The volatility of Ethereum is around 4.5. Of Bitcoin is around 3 or 2.5. So it's a bit more volatile than that. And the expectancy means how much you can expect on average from every single trade. When we go here, it's minus. So this analysis dashboard is here to really take your performance and see, okay, well, if we project this based on the data, if we project this, into the future, are you going to make money or not? The great part is, though, that you can always use this, and you can always, whenever, first, like, you can look at this and be like, okay, well, this person clearly is not picky enough with their trades, and they enter way too fast. Because based on this, it means that the trade profitability is too low and the risk to reward is too low. So it's bad deals and bad probability on trades. So this is what they need to fix. If they focus on the trades they do and they trade more they're more picky with their trades, the entire performance will improve. And we know that because we see the deficiency here. And that's the good part about these trades. You don't need to this dashboard. You don't need to do anything. You just export your order history from any broker ever, and you upload it here, and you'll see all this data that the broker doesn't give you, right? And they don't give it to you for a specific reason. So, and then on top of that, we have the AI interpretation here. So I know we'll need to reload this here. So on here, the AI interpretation, sometimes they're pretty brutal, I'm not gonna lie. The key performance metrics of the trading account in question are concerning. The account's total profit stands at minus 191, implying a significant financial downfall. Additionally, the win rate of 44.9 is slightly below the standard break-even win rate of 50. The win-loss size ratio is 0.8, which means that the average loss is greater than the average win. Finally, a considerable high break-even percentage of 54% reflects difficulties in the trading system's substantial profitability. So, yeah, I mean that's all you need to know really. And then you can read these as well. I'm not going to read them out loud right now. This one might be interesting actually. The more advanced metrics tell a similar story. The Sharpe ratio is negative, indicating poor risk-adjusted performance and potential losses. The daily volatility of 9.5 is quite high, indicating a high risk of price fluctuation, while the annualized volatility of 181 only confirms this apprehension. The negative expectancy of -1 also shows that the trading system is more likely to result in a loss than gain over time. In terms of recovery factor 0.5, the account's ability to recover from drawdowns is gravely lacking. So really it's every single metric. But what it comes down to is these two metrics right here, right? If we look at the overall analysis, suffice to say the account's trading performance has significant room for improvement. Greater attention should be paid to managing risk as the account appears quite susceptible to steep losses. Drawing on consistent trading strategies and proper management protocols could help increase the win rate and bring down the break-even percentage. Right, so what this means is focusing more on the strategy and picking a strategy that, because if you have a good strategy and you stick to it, what that means is that you will have high probability trades. By default, all you need to do is stick to a strategy. So if you don't have high probability trades, what that means is that you're not sticking to strategy. The trader could also consider making changes to their approach or the financial instruments they're trading to buoy the win-loss size ratio. The account receives a QC consistency rating of 15 out of 100, which is pretty low, largely due to its shortfalls in profitability, win rate, and consistent returns. So yeah, that's the analysis of trader number 1, right? Let's go to trader number 2. We looked at them a little bit, which is pretty good, but let's just look at the difference in analysis. This account has a win rate of roughly 68%, which covered its losses and has provided a total profit of approximately $30. The size of profitable trades tends to be 10% greater than the size of losing trades, but the trader breaks even at approximately 47% of the trades. This indicates that while there is a high win rate, the profit from winning trades is not significantly higher than the loss incurred, thereby increasing the break-even trades. So there's more break-even trades here, but still the trader is overall profitable, which is good considering it's a starting trader. The average profit per trade is coming in at 2.7 with a mean drawdown of 1.12. The maximum drawdown is relatively high at approximately $18. That is a high drawdown. And it happened, I'm pretty sure it happened here, right at the last trade here that they made on December 10th. However, the high profit factor of 2.4 indicates that the profits are quite larger than the losses. Additionally, the turnover rate of 5% may suggest that this trader holds positions for longer terms. So that's all good. The Sharpe ratio stands at 0.33, implying that the account could use risk mitigation strategies to improve reward-risk ratios. The daily volatility of this portfolio is high at roughly 4 or 5, which might not be appealing to a risk-averse investor. Annualized volatility stands at 90. The expectancy of this portfolio is positive at 1.6, but the recovery factor is negative, suggesting the portfolio may be at risk during downturns. The recovery factor is how well the portfolio recovers from losses. The account demonstrates profitability and a good win rate, but also carries a substantial level of risk as indicated by the Sharpe ratio, maximum drawdown volatility. It seems that the trader often breaks even, which could be improved by adopting more effective risk management strategies and stop-loss placements, for instance. Adding diversity among asset classes and using combination of high and low volatility assets can help to improve the Sharpe ratio and reduce overall risk. The account's QC consistency rating is 55 out of 100. This account shows potential for growth, but also requires substantial improvements in risk management strategies. It's a good start, though. This is a trader that has just started out, and this is a very, very solid start, something that we can work on later on. But when you look at this, I love what the AI said here, which is, it's an AI that we've basically trained with our data and with our lessons and knowledge and everything. And I actually really like the interpretation here as saying that a combination of multiple asset classes and high and low volatility assets can help improve the Sharpe ratio, which is something that we did exactly right here in those with the strategies. Oops, that's this thing, right? With the strategies. So, and what we did here is we put a bunch of strategies together with different bundles, right? Some of them are more volatile, some of them are less volatile, and we package them together, and the result of that is a very, very high Sharpe ratio and very, very high consistency. So this is an important part here. And this is something that you can beautifully see when you look at the analysis between these two accounts. And on top of that, just the analysis that the Trader AI did, which is that by number one, win rate and risk to reward play a very big deal. So that's number one, right? Here the Sharpe is 3.2, whereas this guy has a 0.3. So that's a different world of Sharpe ratios and consistency. But the reason for that is also like the bundles have overall a much better Sharpe ratio and consistency because they're distributed. And there's strategies like the Turtle and Bully that have a very low volatility, high consistency. And then there's Solana and FTM, which move a lot. And then you have like the Turtle and the Bully that have a high win rate. And then you have Solana, for example, that has a low win rate, but the risk to reward ratio is very, very high, meaning that when the strategy wins, it wins very, very large, whereas when it loses very little. So all of those things are taken, like these factors are taken into account when designing these strategies and trading these strategies, and that's why we can look at them or not look at them for a couple months and they will perform the same way. We have not adjusted these strategies at all, and that's the point. That's the important part. So when you have that win rate and risk to reward, how do you get a good win rate? You get a good win rate because of the strategy. So when you have a good strategy and you have optimized it enough where you have high probability trades of trading, well, that's your high win rate. In our example, our stock strategy, right, or stock scalping strategy, where we look at alignments on multiple timeframes, that by default is going to be a high win rate. Now, the next thing that we need to make sure that our win-loss ratio, or risk-to-reward ratio, is positive. If it is positive, like with this win rate, it wouldn't have to be. It actually doesn't have to be positive. But if it is, then you're attacking it from both angles, basically. And if it is positive, it means that in a trade, we make more than in a losing trade. In a profitable trade, we make more than we lose in a losing trade. And that just comes back to when we set up our trades, when we plot our longs and shorts here. Well, this is what this is. Risk to reward ratio is 6 here, right? So if we trade this, then by default, we will have if we only trade these trades, then we will have a very high win-loss ratio. And when we have a very high win-loss ratio, then we can be more lenient on a win rate. But when we have a high probability strategy like we have with our stock strategy, then the win rate will be high as well. For example, let's go, if we go to a scalper, right? What's the win rate here? 62%, and a profit factor is 1.18. So here we have 68%, right? So it's similar. Above 60 is above 50 is good if your win-loss is good. So depending on how big your risk to reward is and how big your win rate is, that determines your performance overall. And then you have more metrics with overall more additions and more detailed analysis, but this is what it comes down to, and this is the important thing. And when you look at your overall performance, this suggestion here was very precise, because you can see that when you put multiple strategies together, then you will have a much higher consistency. And when your consistency is lower, you will have the same profit or an even higher profit, but your consistency is going to be better. So your volatility is lower, what means that you will multiply the profits that you make. So what this comes down to is the importance on how people and retail traders, how we think about the market and how we think about making money in the market, because that is the biggest difference between retail traders and institutional traders. That's the biggest difference between people that lose money and people that make money in the market consistently. And the difference is because most people, they come in, they go into the market and they have $1,000 or $2,000 or $5,000 or $10,000, whatever it is. And they want to take that money, they want to take that account, and they want to turn it into $1 million. And they're like, okay, if I turn this into $1 million, well, then I'm rich and I'm happy and everything. Which, I mean, the idea of that is nice. However, when you just go ahead and try and turn $1,000 into $1 million, then you need to 1,000x your account. You need a multiple of 1,000 on your account, meaning that when you go into the market, and that's your goal, even if it's a long-term goal, then right away, like the first instant, you are directly at a complete huge disadvantage towards other traders, towards institutional traders that never have to do this. Institutional traders are happy when they make 10% a year, because they have $100 million, they make their 10%, they make $10 million bucks, and they're happy. They blow 2 of it, they save 3 of it, whatever. So, and they will always make much more money. So think about this, right? You are trying to 1,000x your account. So you're instantly at a disadvantage. You're instantly over leveraged. By definition, you're over leveraged. By definition, you're over risking, because you need to risk more in order to make a 1,000 multiple of your account. Whereas institutional traders only need to make 10% per year. And as they make 10% per year, so your chance of turning $1,000 into $1 million is like winning the lottery. It's like winning the lottery. And even then, best case scenario, you made $1 million bucks. And the way you grew your account in order to get to the $1 million bucks, now you cannot trade that way anymore. Now you need to trade a completely different way. So the skill set that you built in order to win the lottery, you cannot use now. Whereas institutional traders have absolutely no stress, are not over leveraged at all, are not over risking at all, make a comfortable 10% per year, and still make 10 times more as you did. Those are the two different situations. It's the same market, but those are two different lives. Those are two different stories, right? It's completely different. And the paradox is that if you would realize that, and if you would, instead of focusing on your profitability, if you instead would focus on building your skill of trading consistently, because that is a skill that can be traded, that is a skill that can be trained and learned, and it's not that hard, by the way, but it needs to be actively learned, like a language. And if you would focus on that, then money would just fall on you. Like if you would have a couple months or even 1 month of live trading data of consistent results, depending on how many trades you trade, but ideally multiple months, people would beg you for you to take their money. And that's also, to put our money where our mouth is, right? That's also why we have the prop challenges. And they're exactly that. If you're a consistent trader, you will pass that challenge and you will instantly trade with 6 figures. And when you trade with 6 figures, you don't have to worry about over leveraging and over risking. Neither will you. Because if you make your 10% a month, you already make 10 grand on a 100K account, right? And that account grows, but it does not grow from your profits. It grows based on your consistency, and based on your consistent performance, you will get more funding, right? You don't reinvest your profits. When an institutional trader is trying to make 10% a year, they take that money out. They don't reinvest it. When you try to turn $1,000 into $1 million, that initial $1,000, you're reinvesting that thousands of times. What that means is that you already won. You were already right in the market. What you're gonna do now is you will spin the wheel again and spin the wheel again and again and again until you lose. Because there's no upside, right? So there's no limit to the upside. You can reinvest as often as you can, but if you lose, you can't anymore, right? So unless your performance is extremely consistent, like your Sharpe ratio needs to be in the level of our dashboards. And if it's not, then by the laws of physics and statistics, you will blow your account at some point. And it will look similar to this. It might not be as aggressive as it is here, but it will look like this. You have your ups and downs, then you have some really nice runs, but then you have a very, very fast line to the downside. Because you're over-risking. Because you're reinvesting the profits that you already made, that you already exposed your money on, and you were right, and you were rewarded for it. Now you take that reward and you need to put it back into the pool. That's how big of a disadvantage you have when you play the game this way. And guess what? 99.9% of people play the game this way. And guess what? All of them lose. All of them lose. All of them. I have looked at so many traders now. I've looked at so many analyses, so many accounts. It's the same thing over and over and over again. The only way out of the rat race is to focus on your skill of consistency and your skill of being able to trade consistently rather than trying to make profit. Because let's keep it real, right? When you trade with $5,000, when you trade with $10,000, like great, but even if you make profits out of that, it's not going to be life-changing. It's not going to get you out of your situation, right? So rather than trying to focus on the profits and then paradoxically lose more and more money because you're focused on making money and not on building your skill, focus on building your skill of trading consistently. And you can learn that skill at any level, whether you trade on a demo account or with $1 or with $500,000. You focus on the skill of trading consistently. And when you have that skill, you will get fun. Like, I guarantee you, like, and this is a promise to you from me right now. And this promise will be valid until I die, which is that if you show me a live trading account of consistent results for at least 4 months, a live trading account of consistent results of at least 4 months, within a week, you will have at least 6 figures in your account. At least. Just like that. Like 1 week is a long time for that. Like you will have it instantly. Your source of funding, like that's done. Right? I'll just do a challenge. But like still, same thing. So, and even if you wouldn't, like people would just throw money at you, right? But even if you wouldn't, paradoxically, who makes more money? Someone that makes 0.5% every single day and starts with $10, or someone like this? It's always the other person, because this person is at minus $91, right? They will never make money, never. It does not matter if they had a great year. They will blow that account. They'll never make money. All they do is put money into the market for other people to take out. That's just the reality of it. So yeah, that's something important. This guy's doing a bit better. Not gonna lie, this guy's doing a bit better. It's not that many trades, so it's not as statistically relevant. But it's definitely a good start. Except this last trade here, it was actually very, very solid performance. What else do we have here? Another loss. Oh, okay, yeah, this is a consistently losing account. This is just the need of trading more, following a strategy. This is a lack of strategy, complete lack of strategy. There is a strategy, but you only follow it when you feel like it, and your emotions take over, and you do very, very irresponsible decisions based on your emotions. That's this curve. This curve is you need to learn the strategy and trade the strategy. That's this curve. This curve is actually very solid. Actually very solid. You have very small losses here. Very small losses. Your hit rate is really high. This last trade, I don't know what happened here. This is something to look at. That's very important. But in general, very, very solid performance. So yeah. Yeah, those are the important parts. And this, based on the QC level, you can kind of see, right? So this account, maximum you're allowed to trade. Like if you trade, so if we do this analysis with you and you're in a group, the QC risk management level is the maximum amount you can lose per trade. No matter what. I don't care what trade it is. This is the max you can lose. So this trader had a 3.3. This one had a 6. And this one had a 3 as well. So yeah, this is overall. And anyone that wants, you can just send me the order history, and we can go over this. Any broker works. We just throw it up, and we'll get a full analysis. I can give it to you in a PDF as well. And then you know what to focus on, and you know how far you're from consistency. But yeah, the most important part is the consistency. And how do you get to consistency? 3 pillars: strategy, risk management, and emotional management. Strategy is being able to follow your trades. This person follows a strategy. And this person sets up their trades so they can leave and come back 5 days later, and the trade just plays out. The levels are there, everything's set. That's how this person trades, because it's going exactly according to strategy. So this one, and seems like emotions are in check as well. Maybe just risk management based on this. This looks like sloppy risk management to me. Here, emotional management. Right? So we have our 3 pillars: strategy, risk management, emotional management. Here it's emotional management and risk management as well, actually, because when we look at our win rate, it's bad compared together with the risk to reward. It's just bad. So those are those 2 pillars. And in here, actually oh yeah, here really it's just strategy and learning, because this is consistently unprofitable, right? So that just means that the base needs to be fixed. Yeah, so that's basically, and right, so like this is, compare this line or this line, oh, sorry, or this line, and that one's gone, or this line compared to this line. It's that's your difference, right? That's literally the difference that I've been talking about. You can see it visually right now, which is right here. So yeah, let me go to QC4. So yeah, yeah, that's everything I wanted to say today, actually. This is something that we'll be covering many times, and I hope I drove the point home today for the understanding on what really matters in the market and what the way is to making money in the market, right? The point is not for you to generate $1 million from $1,000. That's just stupid. The point is to have a skill, to have an asset that other people can invest in, right? Which they will. Which they will. And then you can use your skill set and asset to generate a small percentage of your account. And that number is going to be a high number. That's going to be a high dollar amount. And you will be fine. But that is how you generate money. Because if you go in here like this rogue soldier with $1,000 in your bank trying to make $1 million, and you jump into this deep ocean with the sharks and whales, the killer whales, they will just laugh at you. They will destroy you every single time, because they have so many more tools in their toolbox, because they can have more tools, because they're not that exposed. When you're at a high leverage, in a trade, there's not much you can do. There's not much you can't average in lower. You can't tolerate risk. You can't add in more because you don't have the account size, right? Whereas someone trading here, and this is literally what happened. There's a very, very good trader that traded this way, which was that what he said was that he was using a stock strategy, by the way. And he would short, right? Because there's a full alignment on high time frames. That's another thing, right? You don't have to do low time frames. You can have high time frames that are much predictable. He was trading high time frames, and he shorted, let's just say in this scenario. And he was like, yeah, I mean, if the price just goes higher, I'll just buy more. I mean, how much higher can it go? 50K, 60K? I don't care. I'll just buy more. It's just going to be a better short. And the short's going to happen at some point. And then it did. And that's the way that's the way they can trade. Because even if they short and Bitcoin goes to 60K, they're still not overexposed. Whereas when the average Joe trades and he zooms in right here in this chart, in a 1 minute time frame, and this is his short here. This is his short here. Right? So a stop loss or liquidation, whatever they do, is from 46.8 to 46.9. Well, it doesn't matter if Joe's right or wrong. He will blow his account at some point, because he's going against someone that does not care if Bitcoin goes to 60K, and they will still be profitable because the short's going to happen at some point. Whereas there's someone that does not have the account size to have that move and make enough profit, so they need to over leverage, and they don't have extra account size to add in too. So this wick is just going to kill them, and that's it. Well, Joe focuses on the completely wrong thing, because what Joe should be focusing on is trading consistently, making a basically portfolio of consistent returns, and then showing it to this guy that doesn't care if it's at 60 grand. And that guy will very quickly give him a couple $1,000,000. And even if not, like 50 grand or 100 grand, whatever it is. And this is like, anyone in the Discord shows consistent results, they will be funded. You have your challenges. You can do them right now. So yeah. So that's basically it. That's the difference. That's the difference in thinking. And because of the difference in thinking on how to generate money in the market, one set, right? One set has a very, very high valuable skill of consistent returns, and then they take a large amount of sum that they got, by the way, because of their skill set, no other reason. They just showed that they have the skill set, which you can show every single day in this Discord. And then they just make a small percentage on that account, and they can do that consistently without a problem, because no matter what, they will never be in deep trouble. And then there's the other set that takes 100% of their account and risks it over and over and over again every single day, while being over leveraged, while over risking. And all they do is they just put in money for those consistent traders to take it out. That's all. That's the completely wrong way of looking at making money in the market. The completely wrong way of investing, by the way. So rather than doing that and being in the rat race with all the other retail traders, focus on building your skill and then leverage that skill. And then you can trade money that's not yours, right? So even if you mess up, guess what? It's not really that big of a problem because it's not your money. And you'll be able to risk much less because you have much more money to play with. And you have completely different freedom in trading. Instead of being stressed out every single moment if you're going to hit your stop loss. So yeah, that was my TED Talk for today. If you guys have any questions, let me know. And other than that, I'll see you guys in the Discord.